I think we probably should take the macro and then boil it down to the startup. So at the macro level, I think that we're playing a very dangerous game of chicken with the Fed. And you can kind of summarize it in the following way, which is that, 3 or 4 months ago, we only thought that there was going to be a handful of interest rate increases. And increasingly what has happened, the market has remained so resilient that the Fed has sort of put out more and more data as the data has justified them being a lot more aggressive. And it kind of crescendoed this past week where they basically said, listen, we're going to move by 50 basis point increments for the foreseeable 2 or 3 rate hikes, and we're going to start quantitative tightening. What does that mean? That means that instead of basically printing money and coming in and buying securities from the market, right? So what happens? When they enter the market with money that they literally do print and buy your bonds, they're giving you cash in return. And typically what that has led to is the inflation of all assets, right? Equity assets have gone up, bond assets have gone up because there's just nothing else to buy. When quantitative tightening happens, they reverse that. And what they're going to do is about $95 billion a month of the opposite action, which means they're taking money out of the system, right? Or in this case, what they're going to do is they're going to let a bunch of maturities roll off and not renew them. Okay, so why is this important? Well, it's important because, we're still 4% from the highs. So we have 7% inflation. We have all this crazy stuff happening. We have a war, going on. We have massive price issues. We have supply demand issues, and the market keeps shaking it off. So I think what the Fed's going to do is get even more aggressive. So you're going to probably see, a lot of 50s, maybe even a 75 point hike. You probably are going to see them, even ratchet up quantitative tightening until there is a bit of a bloodletting in the equity market. They need to see that the market's cracked.
And so they literally need to see what percentage drawdown or just to go sideways. What do they need to see in order to, or is it inflation coming down a couple of points?
Well, the problem that we suffer from is that they're going to look at the highest level indexes, right? They're not looking at single stocks. And so when when you and I think this market is down 4%, we don't feel that because some of our companies are down 50 and 60%, right? But that's because we're all focused on high tech growth. But they look at the broad indices, and the broad indices have held up really well. And mostly it's because, if you look inside the S&P 500, 40% of every dollar is, Apple, Amazon, Microsoft, et cetera, Tesla. So we're in a situation where I think until the Fed see that there's a massive trading of liquidity, which means you see these indices crack big time, 3,600 in the S&P, they're just going to keep ratcheting things up. As it comes all the way down to our companies in Silicon Valley and tech, what that means is you have to start planning for the worst. And I think the worst means that there's an 18-month period where you cannot raise money on your terms. You have to raise money on the market terms. And so if you're not in a position to show good growth over these next 2 years, I would encourage you to just get your balance sheet in order to wait it out.